Okay, so I want to tell you about the absolute worst financial decision I've ever made. And honestly, I'm not sharing this because I'm proud of it, but because almost every single new investor makes some version of this exact mistake. And nobody tells you about it until after you've already paid for the lesson. Welcome to Zak Wealth Files. In this explainer, we're going completely under the hood of a massive wealth building trap. By the end of our time today, you're going to walk away knowing exactly how to identify this mistake in your own life and the precise step-by-step framework to fix it. So let's dive in. $40,000. Yep, that is exactly what this mistake cost me. Now here's the real kicker. I didn't lose this money in some spectacular crypto crash, a shady internet scam, or by picking a terrible stock that went bankrupt. Honestly, that would almost be easier to swallow. Instead, this was just a slow, quiet leak over the course of about 2 years. I lost out on this money simply by doing nothing. I lost it by waiting. And the absolute worst part? At the time, I didn't feel like I was making a mistake at all. The crazy part is, I actually thought I was being a genius. It felt like this brilliant strategic move built on a really seductive idea, just waiting for the perfect moment. You see, a few years ago, I finally had some real money to invest. I'd read the books, watched all the tutorials, and honestly, I had a pretty bad case of beginner overconfidence. I genuinely thought I could time the market. So I built my entire foundational investing strategy around sitting in cash, just waiting for the perfect, optimal entry point.
Let's break down what market timing actually looks like when it leaves the textbook and collides with a real person managing real money with, real human emotions. In theory, market timing sounds incredibly reasonable, right? Wait for a dip, buy low. Don't be the sucker who buys at the top. It's literally flawless logic on paper. But the reality? Your uninvested cash just sits there on the sidelines, essentially earning nothing, while you wait for a perfect entry point that, and it took me way too long to accept this, just doesn't actually exist in any predictable, repeatable way.
Let me just walk you through my actual, completely exhausting sequence of events. So month 1, I make my initial investment. Great. Month 3, the market dips slightly, I panic just a little bit, pull back, and tell myself, hey, I'm just protecting my gains. Month 6, the market recovers, but instead of getting back in, I tell myself, well, I'll wait for the next dip. I definitely don't want to buy high. Fast forward to year 2, the market keeps climbing, and I wait even longer, totally convinced a crash is right around the corner. Compound interest is supposed to be like a snowball rolling down a hill, quietly getting bigger and bigger over time. Well, I was essentially stopping the snowball every few months. I was always reacting and always slightly behind the actual movement of the market. We really need to shift gears from the math of that lost 40 grand to the underlying human psychology here. Because incredibly smart people fall into this exact trap every single day. Ask yourself this, why does this happen to so many first-time investors? If you've ever felt that pit in your stomach when your portfolio goes red, validate that feeling. It's not about a lack of intelligence. It really comes down to a fundamental mismatch between how our brains are wired from an evolutionary standpoint and how modern financial markets actually behave.
It all comes down to a little thing called loss aversion. Our brains are built to avoid pain way more aggressively than they're built to seek reward. And the behavioral data is crystal clear on this. Losing $100 feels significantly more painful than the pleasure you get from making $100. I mean, think about it. Finding 20 bucks in an old winter coat is nice, but dropping a $20 bill down a storm drain, that will literally ruin your entire afternoon. So when the market dips even a tiny amount, that evolutionary discomfort kicks in immediately. And the absolute easiest way to make that discomfort vanish? Pull your money out. It gives you a false, dangerous sense of control and safety.
And this brilliantly illustrates the danger. If your whole strategy is getting out when it's scary and jumping back in when it feels safe, you are structurally guaranteeing that you will miss the strongest recovery days. Why? Because historically, the market's absolute best, most explosive recovery days occur right after the absolute scariest drops. Like, they are often clustered together within days of each other. So trying to dodge the bad days almost always means you accidentally dodge the best ones too. Fortunately, the solution to this $40,000 mistake doesn't require you to suddenly become a Wall Street genius or find some secret stock pick. It just requires a simple behavioral shift. Here is the framework that changes everything. Dollar cost averaging, or DCA for short. This simply means investing a fixed amount of money on a regular, predictable schedule, say every single payday, regardless of whether the market is up, down, or sideways. You're no longer guessing. You're systematically buying in at all kinds of moments. Sure, some will be high, some will be low, but your average cost smooths out over time. But most importantly, it takes day-to-day emotional guesswork completely out of your wealth-building strategy.
The crucial point here is the massive gap in growth potential. Staying consistently invested through DCA drastically outperforms the stagnation of holding cash while trying to time the market. Now, I want to be totally honest with you here. In the theoretical world where you could perfectly predict every single market dip, timing the market would win, for sure. But perfectly predicting dips is just not a repeatable skill for the overwhelming majority of humans on planet Earth. DCA is the realistic strategy that actually protects average investors from missing out on long-term compounding growth.
I want you to literally burn this quote into your memory. Decide on a plan while you're calm, and then follow that plan regardless of how you feel in the moment. Seriously, the version of you that is panicking while watching a red stock chart on a random Tuesday, that is absolutely not the version of you that should be making long-term financial decisions. You need to make the decision once, rationally, so that your panicked future self doesn't have the steering wheel. At Zak Wealth Files, we believe clarity beats excitement, and I want you to leave this explainer knowing exactly what to do next with your real money. Let's walk through the playbook. Step 1. Figure out your actual time horizon. If you don't need this money for 10 or 20 years, today's little dip honestly doesn't matter. Step 2. Pick a consistent automatic schedule. An automatic transfer to your brokerage account every payday makes the habit totally invisible and effortless. Step 3. Decide in advance what you will not do. Like actually write down, I will not sell based on a scary news headline. Step 4. Institute a short waiting period. If you feel the sudden urge to change your investments, force yourself to wait 72 hours before logging in. Just let the emotion fade. And Step 5, review your plan, not the market. Check if your plan still fits your life goals rather than stressing over what the S&P 500 did this week.
Now, I do need to add a quick, totally honest caveat here. Everyone's risk tolerance, income, and timeline are different. Investing always carries risk, including the potential loss of principal, and past patterns are never a guarantee of future results. What we discussed today is general education based on common, well-documented human behavior. It is not personalized financial advice. Before you make real decisions with real money, you should always consult a licensed financial advisor to look at your full, specific picture.
Wealth isn't built through adrenaline-fueled reactions to daily market noise. It is built through consistent, premeditated plans. My $40,000 mistake wasn't one massive blunder. It was 100 small, emotional decisions that quietly drained my potential wealth. So write your plan down and automate it. If this explainer gave you some genuine clarity on your own investing habits, that is exactly why Zak Wealth Files exists. Hit subscribe for more honest, hype-free breakdowns and take control of your snowball today. I'll leave you with this. If your current strategy relies on outsmarting millions of other anxious investors on a random Tuesday, what is your hesitation actually costing you?